Hi, I'm Ryan, the Frugal Analyst. Banks are having a tough time. Silicon Valley Bank, or SVB, collapsed in less than a week. First Republic Bank received emergency funding. We have a banking crisis, and one critical reason is the historic rise in interest rates. I will explain how interest rates affect these banks and tell you what I'm doing with my cash to avoid the banking crisis. First, let's try to understand how banks make money. Banks typically make money by holding a deposit and investing that money elsewhere. They pay the depositor a small interest rate and invest at a higher rate of return. The difference between what they make in interest and what they give to depositors is how banks make money. The main reason why banks fail is that the investment they held lost enough value to make the bank worth zero. It doesn't show zero in the balance sheet, but if they were to sell all the assets, it would wipe them out. In the case of SVB, they sold $21 billion in US Treasury at a $1.8 billion loss. That's a drop of 8% coming from assets guaranteed by the US government. In addition, they have a huge $92 billion portfolio on their balance sheet, and if they were sold, it would probably wipe out any equity in the company. They didn't sell, and the FDIC took over after almost a $1 billion cash deficit. So how do banks lose so much value in a safe asset like US Treasury that is practically guaranteed? We need to understand bond pricing with interest rate impact. In the case of SVB, they sold $21 billion of securities at a 1.8% interest rate with a 3.6-year duration. The risk-free rate is 4.5% for 4 years. I got this number using the average 3-year and 5-year treasury rate on March 8th when SVB sold the portfolio. Using a bond calculator, the price of the bond would be around 91 cents to the dollar, which is roughly how much they lost on the sale. So why is the asset discounted to 91 cents? On the other side of the trade is a bond investor. They will look at the best deal that gives them the most return. They can buy Treasury at around 4.5% yield or buy SVB portfolio with 1.8% yield. To level the yield, the seller discounts the bond to the market rate. In addition, the bond discount gets worse when the duration is longer. Doubling the years to maturity, the price drops even further. Switching over to First Republic Bank, they held these held-to-maturity assets and displayed their fair market value in the annual 10K investor filing. You can see that the total carrying value for held-to-maturity is $28.4 billion and the fair value is $23.6 billion. That's a paper loss of $4.7 billion. Most of the drop came from after 10 years to maturity, which has a larger duration risk. Now you might wonder, why do banks take such a huge risk with a long duration asset? In recent history, yield for longer duration were higher than short-term duration, and thus the bank can make more money by investing in longer-term assets. Banks typically do not trade their assets to bet on rising or lower interest rates. They just buy and hold. With interest rate changes, they will sit on their position until they are forced to liquidate. After all, the sudden rate change is unprecedented and unlikely to happen until it did happen, and that's the banking crisis. So where should we park our money? I try to bypass the bank as much as I can. Banks have their purpose. I still use them to deposit checks and send money, but most of my liquid cash is stored in a brokerage account that invests in short-term treasuries. I have another video called How to Optimize Cash where I go over the detailed method to pay bills through a brokerage account and ultimately maximize cash yield without using a bank. So thanks for watching. Let me know if you have any questions. Please hit the thumbs up and subscribe and comment. I'll see you in the next Frugal videos.